Good Wednesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the shared screen and the disclaimer. Neither Dimitri, myself, or Market Chameleon are registered investment advisors or broker dealers. If you need to reach out for investment advice, please research and find a broker dealer and speak to them. This show is for informational purposes only concerning Market Chameleon tools. And with that, here is Dimitri Pargamani.
Good morning, Will. How are you?
Hey D, how you doing?
Pretty good. Let me share my screen. If you're joining us for the first time, welcome. As a note, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube. Will's watching it, and he'll read it back to me. And what we're going to do is give you a few minutes to put in those questions. While you're doing that, we'll take a look at the pre-market report to see if we could get insights, what's going on in the pre-market hours, and then we'll move on to the questions. All right, so on this pre-market report, up top, you do have this calendar view, which shows the last weeks of data, and it gives you a summary stat of what happened in the pre-market hours that day. This allows you to kind of just eyeball if there's any kind of trend or something unusual. If you click on that date, it's going to take you to that historical date and what happened in the pre-market. Historically, you could also go back further using this calendar. However, today we're on March 13th over here. And as we could see, so far we see 456 stocks are trading higher in the pre-market, 372 stocks trading lower. We have 143 million shares trading on up volume versus 56 million on down volume. If we convert that volume to dollar value, we have $1.1 billion worth of stock trading higher. However, we have $4.9 billion worth of stock trading lower. So this gives us some mixed signals here. There are more stocks up, more volume up, but if we take the dollar value of the stocks trading, then the down volume exceeds the up volume when we convert it to dollar value. Let's look at it from a couple more perspectives, then we'll move on to the questions. When I slide down the page a little bit, we get this more granular view. Now we see some stock symbols in the pre-market hours with price changes, volume, indicators. We have the most active stocks, our biggest percentage gainers and biggest percentage decliners. I see 71 stocks made our biggest percentage gainers list and 54 on our biggest percentage decliners list. And now, to make this list, we do set thresholds for liquidity, volume, price changes, because things in a pre-market tend to trade with less volume, less liquidity. But if it does meet that threshold, the stocks can make it onto this list. And that includes small cap stocks. You could see over here, we have a market cap column. It could include an ETF. It could be an inverse ETF. It could be any leverage products, closed-end fund. So to narrow down to a small group of stocks, we could use the filters above. If you have a watch list and you save your watch list and you track, and you just like to track a certain group of stocks, you could use that filter and filter out this list based on the stocks that you saved in your watch list. We're going to use this one, an ETF filter. When you click on it, you get a drop-down menu to select from. We're going to choose the first one, which is SPY. And as you can see, when I did that, the list below got filtered by stocks that are holdings in the SPY ETF. And these are the S&P 500 constituents. And here we see 5 stocks met the conditions to get on our biggest percentage gainers list and 9 on our largest decliners list. So that indicates a little bit of a bearish lean in the pre-market hours. So really we're getting, some mixed signals here. Nothing that's pointing to overwhelmingly bullish or bearish. It just depends on which perspective you look at it. So I'd say just a mixed bag so far. And well, we gave it a couple minutes. If you have a question, I'll take it now.
Yeah, no questions. But Jim made a statement. I guess Schwab reported today to their clients that starting May 28th, settlement day will be T+1. I don't know if you've seen that anywhere.
Yeah,
But
so I heard that. Yeah, that's coming up.
all right.
And yeah, so that will have some significance to certain things. Definitely the way stocks settle. So they're going to settle now quicker, T+1 instead of T+2. And I think that if we look at traditionally like X dates where you have to own a stock before the record date, well, that's going to move up. So right now you have to buy it the day before record date, the trade business day before the record date, because it takes 2 days to clear, right? So you need to buy it, and by the time it clears, then you're holder of record, and then you're entitled to that dividend. So that's going to change, and keep an eye out for it, and once it gets closer, and we definitely know that that's the official stance, we'll have to update that. So that's one thing to keep in mind. Yeah, thank you for bringing that up. And obviously it'll affect, option prices as well, because you have to exercise an option prior to the X day, prior to the to convert that option to stock, so you're entitled to that dividend. So for early exercises and so forth, all that will change. Okay.
We did have a question from Heat, a general question. Is there a list, or I guess some way to search from the entire market, the stocks that have options to trade?
Well, most of our reports deal with options. So you could just look at the options volume report really over here. So these are all the stocks with options listed. So this gives you a breakdown of the volumes in the options and so forth. So I mean, over here, this is a list of those stocks that are trading options.
And any stock you bring up and look at the availability, if it doesn't have an options chain or an options, if the stock doesn't have options, we don't give an option.
There's no data.
In it. Yeah, there are no tools available in the options.
Yeah, but I mean, there's you could probably go, I don't know, to even the stock screener, and okay, so here it has options listed. So you can press this, has options, and it'll give you the list of stocks that 5,608 that have listed option securities. It doesn't, some of them might not trade any option, some of them might not have any volume. But you could do it from the stock screener. I mean, there are lots of places you could do it, but options volume over here is, you have a list of the symbols and the volumes, and you can use those filters here.
Perfect. Rob also asked for the link to yesterday's IBKR webinar. So I put that in the chat as well for anyone who wants it. And I'll also put a link to IBKR has all of the webinars Dimitri's ever done. I think there are 34 of them now in a library. So they just dropped there as well. Also, any other reports Dimitri has put on the site are there. So it's a very good resource tool.
All right. Thank you. Let's see if there are no questions. Maybe what I'll do is cover a feature tool somebody brought up, and one of the questions was to compare the implied volatility skew or vertical skew to different expirations, right? So I think that, let me see if we have it on here. Or actually, sorry, we'll come back to this, but I think it was looking at the implied volatility IV structure, right? And this compares how the implied volatility of a constant maturity 30-day, 60-day, 90-day, 120-day. If we looked at that, a constant maturity at the money, this is how the implied volatilities kind of moved together over time in SPY. We could also just change this by differences, where IV 60 versus 30. So we can just let go and kind of do that. But what if you wanted to compare an actual expiration, not constant maturity, but you wanted to compare two separate individual existing expirations, not just the at the money, but the entire volatility smile, right? So for example, if I'm on the options chain, here are the different expirations. So if I just compared the at the money implied volatility, I could see like here March 18th is 10.6. And if I wanted to compare it to something in April, like here's April 12th, it's 11.5. So I could just visually see that from March to April, there's a difference of almost one volatility click 0.9. Right. So that's comparing the two different expirations at the money. So that would be pretty easy because we're just looking at two numbers to compare. But what if our interest was to look at this volatility structure, because you could see that every strike has a different implied volatility, right? As you go up, implied volatilities change. As you go down, implied volatilities change. So we could see that there is a volatility skew in that expiration, right? So March 18th has a volatility skew. And if we go to April 12th, well, we also see that there's a implied volatility skew. So you could see from that the money, from here's 11.6, 11.5, 11.2. So each strike has a different implied volatility, and that's what we call skew. So what if we wanted to compare these two different expirations, and we wanted to line them up by strikes and compare the differences by strike, right? It's just to line them up, fixed strike, and see what the differences are, strike by strike. And if the skews, kind of followed in parallel, the same, does the skew look similar, or do they look different? Do they cross? Are they inverted? Like, how do we do that? Right. So that was the question, aside from constant maturity. So we want to look at two actual existing expirations and line them up. So to do that, right, we're going to go to the volatility skew. Okay. Now we have these different tabs up here. Okay. And this one here is compare expirations. So you could see, I have IV 30, IV smile graph, and then these are compare expirations. Okay. So what this does is allow me to select the different existing expirations and then look at how the skew compares. So let's take off March. So this expired yesterday, so this has no skew anymore. that's done. Let's take away which one was I talking about? Well, I think March 18th, and then April 12th. All right, so now we have these two line charts, right? So the yellow one is March 18th. Okay. The purple one is April 12th. So there are two ways we could try to compare. One is by delta and one is by strike. So the first one is, so you could see here, you could toggle down here. Let me close this to make this bigger. So by strike, saying that's how we're going to compare. It doesn't matter the delta of the option, right? It doesn't, because the delta of the option is going to, we derive the delta of the option from the Black-Scholes model. So, there are things that go into it that will make the delta of the options change, including implied volatility, interest rates, dividend, forward rate, all that. So if we just compare by strike to strike, if you're just doing a calendar spread, this is what right now it looks like. So March 18th, looks like there's less, there might be less strikes there, or the strikes then just fall to zero, so we cut them off. So you could see here that if we look at and this big dark line over here is, I think that's where it's near at the money, right? It's near the spot price, sorry, that's where the spot price is. So this large dark black line represents where the stock closed last. So here we see a couple things. It looks like the longer dated option, April 12th, right? If we look at it, that the implied volatility is higher on the same strike, which makes sense, right? It's 10.6, 11.5. And if we look at the downside, it looks like as we go down in price, the shorter dated option, March 18th, slopes much faster to the upside, right? So the downside, right? We're from down here. If we're looking at the downside, it looks like it slopes up much faster, right? And to the upside, we kind of see the opposite, right? That it looks like the longer dated option, kind of levels off, maybe has a small slope, to the upside, while the shorter dated, kind of continues to kind of quickly slope down and then levels off over here, so probably I would say that at the monies are, so keep in mind that at the monies, those are going to be a little bit different because they take into consideration cost of carry and so forth. So this is strike by strike. We could just compare those two, and we could add another one if we wanted to, like May. And then we have three of them up there. It gets a little bit maybe harder to read as you add too many of them, but this allows us to just visualize implied volatility smile expiration versus expiration. Let me take this one off for now. What if we lined them up by deltas? All right, so now what we're going to do is do the comparison. Instead of by strike, we're going to do by delta, right? What is the 50 delta versus the 50 delta, 25 delta versus 25 delta? So let's try that. So here It's a little bit different now. So here it looks like they're a little bit now more in sync with each other. It looks to me like to the downside, they converge a little bit quicker. There's less deviate, less difference between the two as we're going to the downside, but they both slope up. So it looks like a quick, right? Very quick steep slope to the upside. To the downside. This is going right. This is going to the downside. Okay, so this is the delta in the call. Now, as we're moving higher strikes, right, less and less deltas in the call, it looks like they both really just level off, and they maintain kind of, and I'm just eyeballing it, like a fixed difference between each other. That's what it looks like to me, or almost like a proportional difference between each other. So that's just comparing two different expirations against each other. And what we were trying to do is look at not just the one implied vol versus the other, but what we're trying to do is look at how the smiles compare versus each other, right? How one smile compares to the other one. So here we see longer dated smile. If we do by delta, right, the longer dated smile is shifted above the shorter dated one. Looks like, across all deltas, maybe they converge down up here somewhere on the tail, right? And maybe here something a little bit funky going on, and then it doesn't look like they widen out a lot from each other, but the widest is to the upside. Right, now let's try to add one more here. Let's say we add June. So now we have 3, right? So keep in mind, yellow's over here is the shortest dated, March 18th. Purple, April 12th. That's the one in between. That's the second expiration, and the longest one is June 28th, which is the top one. So here, what do we see? That it's the way the tail slopes to the downside, right? To the downside. These are based on call deltas here, right? So this to the downside, they all look, like they take a similar shape. The further we go out, though, it looks like that the distance to the tails increases. So this is now June 28th. If we go out there, it looks like they all slope the same way, curve the same way, except as we go out further, those tails look like they shifted higher by more than where the at the monies are, or the upside. Okay, so maybe that reflects people's demand to hedge themselves out longer term.
Hey, D?
Yeah.
We had a question from Chris. He said, can we use the difference in the monthly IVs to find diagonal trades? Is there a way to use Market Chameleon to scan for them?
So we don't have like a screener for diagonal spreads. No. And when we think of diagonal spreads, sometimes what is a diagonal spread? You have two different expirations and two different strikes, right? When you do two different expirations, you're going to have two different forward price, right? The forward price takes into consideration your interest and dividends, the carry costs. So sometimes a diagonal spread is really a spread between two at the monies, right? So the at the monies aren't always the same strike, because as you go out further and further in time, let's say you don't have a dividend, but if you have interest rates, right? So the forward price is higher because it's saying, well, today, if today's price of 100 is maybe equivalent to 105 a year from now, because there's 5% interest rate, right? If the Fed funds rate is 5%, well, in a year from now, $100 today is like $105 a year from now, right? So the forward price is different as you go out further and further in time. So when you're doing even a diagonal spread, sometimes you're actually, you might be doing an at the money versus an at the money, but there'll be different strikes. So, and if you're doing the same strike, you might actually, be doing a diagonal spread in relative terms, because you're actually selling a lower strike and buying a higher strike in relative terms. But we don't have a screener that's does that, but you could see if there are diagonal spreads actually trading in the market, right? So if I went to SPY right now and I wanted to see, well, what are the multi-leg trades that are actually trading out there in the market? So this will look up and scan. We're not open yet. This is yesterday's trades, March 12th. And here's these are, sorted by highest volume trades. So there's a diagonal put spread right there that traded yesterday. April 19th, May 17th, the 484, 487 put. So you could see the two different expirations. One is 38 days to expiration, another one 66 days to expiration, and the strike prices are different, through $3 apart. So if you're just looking for certain things that may be trading out there, you can do that scan here, and you could just look through here. There are 831 different diagonal put spreads yesterday. There's 1,000 diagonal call spreads. So if I click just on diagonal put spread, here are all the different diagonal put spreads out there that traded. So that's, you can do that. But, when you create a screener, you're, well, what are you screening by? What's the criteria? So, we're right up at 9:30. I might just end it right there then.
Perfect. Thanks for the questions, everybody. Actually, we did have a question outstanding from Rob about using the calculator to filter gamma and delta. I'll copy that. Maybe we can go over that tomorrow. Good. Awesome job, Dima.
All right, everyone. Thanks for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Trade in peace, chameleons. Everyone have a great day. Thanks, D.